Good morning and welcome to the Killik & Co market update. We've had a slightly better week for markets with some signs of stabilization for US equities. Here's the S&P 500 over this year to date. You can see it hit a low on the 13th of March and has since come up a bit. The Federal Reserve announced this week that it will be leaving interest rates on hold for the time being, although it did say it expects to cut rates twice over the course of the coming year, and markets did react well to this comment. Bond markets and therefore bond yields have been moving to price in these expected interest rate cuts. Here's how the yield on the 10-year US government bond has moved over the last year. The yield rose towards the end of 2024 due to the expectation that Trump's tariffs would cause inflation and therefore the interest rates would have to remain high to control that inflation. The yield has come down since then based on the expectation that the Fed might have to cut rates to support US economic growth. The central bank has quite a difficult balancing act here. On the one hand, tariffs are causing inflation. Here's what Chairman Jerome Powell said this week. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. On the other hand, the scale of the tariffs is expected to harm US economic growth, and lower interest rates would be a way to mitigate this. Here are the economic projections that the Fed published this week. The figures in italic show the projections that were previously given in December. You can see that growth for 2025 was expected to be 2.1% back in December, but this has now been reduced to 1.7%. For 2026, the figure has been reduced from 2% down to 1.8%. Unemployment for 2025 has been moved up from 4.3% to 4.4%, and inflation has been raised from 2.5% to 2.7%. So we'll be watching very closely to see how the Federal Reserve handles this very difficult situation. We mentioned in a recent video that some share prices have reacted negatively to the actions of DOGE, the US Department of Governmental Efficiency. Companies that earn a lot of revenue from the US government are likely to be impacted by Elon Musk's cutbacks. This week, Accenture CEO Julie Sweet acknowledged that the cutbacks are already having an impact. She said the new administration has a clear goal to run the federal government more efficiently. During this process, many new procurement actions have slowed, which is negatively impacting our sales and revenue. The US government accounted for about 8% of Accenture's revenue in the last year. As you can see here, the share price has declined since the election of Trump. Trump has previously been very concerned with the performance of the stock market, so we'll have to wait and see how he reacts to this. But please do give us a call if you have any questions about Accenture in the meantime. And finally, some changes have been made to the basket of goods that the UK inflation data is based on. The basket is managed by the Office for National Statistics, and it is intended to be a reflection of how people in the UK spend their money. The latest changes did suggest that the ONS is perhaps a little bit behind the times. Video subscription services have only just been added, and DVD rentals have only just been taken out. Around 60% of UK households are now thought to have Netflix. As you can see, the shares are now up by over 150% on a 5-year basis. Other additions include VR headsets and men's sliders or pool sandals, and removals include newspaper adverts, as it's now accepted that most people will advertise online instead, and in-store cafeteria meals, which is a reflection of the decline of department stores. It's always interesting to have a look at how our inflation data is calculated. Moving on to have a look at next week, it's looking fairly quiet on the calendar, with no companies on the Killik covered list scheduled to report. So that's it from us. Have a great weekend, and we look forward to seeing you next Friday.